Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on 9/26/2021. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. Markets are extremely volatile. Please do your own research and trade responsibly. All right, let's go ahead and rip through our assets over here. Obviously been quite a bit of news lately. A lot of volatility in the various markets. We had, obviously, the Fed meeting and comments, etc., questions last week about tapering and whatnot. Everybody is scared about the Evergrande blow up. Half the people are saying, Tom Lee style, the market's going to melt up. Half the people are saying the market's going to melt down. 90% of the world thinks the dollar's going to nothing. Everything from this is the end of the world to this is the beginning of a bull market. Who do you listen to? How do you protect your wealth? How do you grow your wealth? Is any of this information actually useful? Does anyone know what they're talking about? Or is this all speculation? Well, let's take a look at the technicals. Let's take out all the fundamentals, take out all the BS, all the speculation, all the questions, all the noise, all the fog, all the smoke, all the BS, all the bias. And let's look at the actual charts. As we approach the end of this month, the quarter, and now we're going into the final quarter of the year, let's get a more accurate picture on some of the longer time frames as to what we can expect and what's going to actually happen here, rather than speculating, rather than, pitching our own agenda, trying to get people to jump on whatever bullish or bearish bus that we're on. One thing I notice is this cult mentality all over the place. Everybody's in a cult. Nobody is diversified. Nobody is talking about if this, then that. What if I'm wrong? What if I'm right? How can I invest so that I'm in good shape regardless? No one's talking about any of that. Everyone's in the gold cult, the crypto cult, the inflation cult, the deflation cult, the end of the world, the beginning of the bull market. Everybody's in a cult. And you know what? It's pathetic, because in the end, all these cults aren't going to win. So if you're in one of these, 10 main cults, let's say, maybe one or two of them, their outlook will be correct. Oil's going to zero. Clean energy's taking over. Oil's going to the moon. Clean energy doesn't actually work. Deflation, inflation, all this junk. When it's all said and done, I don't care if I'm right. I don't care if I'm wrong. What I care about is making money and protecting my wealth that I have worked very, very hard to acquire. And regardless of what you think or you want to believe, people wouldn't buy a lottery ticket if they didn't think there was a chance of them winning. People wouldn't buy cryptocurrency if they didn't think it was going to go to the moon. The problem is you have to be able to determine the difference between an actual investment, a viable investment, and a lottery ticket. And I think that's where a lot of people get hung up. So let's look at this without our bias, without what we want to happen, without the hoping and the wishing that we won't have to go back to some shitty job or, our old shitty life, or banking on something that has an extremely low probability but an extremely high payout. Instead, let's look for things that have an extremely high probability of working in our favor, with a steady, strong possibility of, making gains over time. Look for things that are valued, undervalued, not buying into bubbles that are probably going to burst, if not this week or this month or this year, sometime in the very near future. Because the truth is, when it's all said and done, if we're going to be legitimate investors, if we're going to be legitimate traders, if we're going to do well over time, we need to focus on the main things that I always focus on, what I have designed my entire trading and investing strategy based off of. And those things are probability of success. How likely is the outcome that we want or we see in the charts to actually play out? 1. 2, risk reward. What is the benefit that we're going to receive if we're right? And how does that compare to what we have to risk to find out if we're right? And in order to actually take into account risk and reward, we have to have definable levels of profit taking, or potential targets to the upside, as well as invalidation targets, or areas that tell us that, what we were expecting, what we were hoping, what we were seeing in the charts is in fact not playing out, and that we were wrong. We need to get out of the trade, take a step back, and then see where we go from there. And then, obviously, in order to increase your possibility of success, you need to have proper, risk management, position sizing. If you have a system that works 75% of the time, but, you make 4 big bets, you might lose because you didn't get a chance to let that probability play out over time. But if you set it aside and divide up your bank and you're allowed to make 100 bets, the probability of that 75% chance playing out in time is going to be much higher because you're allowing the probability to work in your favor. And it's the same thing with a 50-50. If you go, flip a coin and you say 50-50, I'm going to bet on heads or tails, and you only take 2 bets, you might bet heads twice and it might go tails twice and you're out of the game. But probability was 50% chance you'd be right. You just didn't allow, through position sizing, that probability to play out in your favor. And often human psychology, mentality, whatever, plays out that when you're up, you think you can't lose. And when you're down, you take extra risks to try to get back to where you started. So that works against you in both ways. If you win 2 bets in a row, you might be betting even higher now because you think you're going to win again because you're on a roll. If you lose 2 bets in a row, you might try to double or triple or quadruple down because you're down and you just want to get back to even. So if you can keep all these things clear and definable and let these things work in your favor, you'd be much more successful over time. And that's what my trading strategy, that's what my technical analysis, that's what all this is all about. And then when you take into account fundamentals and things like what's the future going to look like, what minerals, what materials, what technology is going to change the world, that's where your fundamentals can help you to get on the right side of like long trends. But in the end, all that stuff plays out on the technicals regardless. So while that can help to strengthen your case one way or the other, for or against something, the truth is all you really need is technical analysis coupled with risk reward, probability of success, and basically the strategy that I use. So that's why it's so important. The first and foremost part of my strategy is determining the trend. Are we in a bullish or bearish trend? And once we can determine that, that can help us to get a higher probability of success. And that's what this is all about. That's what the TJD master indicator that I use on my charts is all about. And then obviously, the jewel thief and the TJD TDMACD as well to help determine the momentum, when we need to take profits, etc. And then by using things like Fibonacci targets, by using things like, the retraces, the Fibonacci extensions, various support and resistance, we can strengthen our case, see key levels in the market, and then we're able to identify those clear areas that we need to pay attention to. So that's what we're going to do today. We're going to go through a bunch of different asset classes and take a look at what's going on and try to get an overall macro view of the market and what we can expect. So let's start here where we always do. What's going on, CW? Good to see you over there in the chat, my man. We are live, and we're live. Yeah, the truth is coming, my man. Good to see you, Adam Yu, 1978. I'm not sure if it's Adam Yu or if your first name is Adam Yu, but either way, what's up? Good to see you guys. So let's get it started here. Let's take a look at the 10-year. Obviously, Fed meeting. What are we looking at here? So right now, we've got basically like 2017, end of 2017 here, and then present 2021. So we're in a very long trend underneath the 200 exponential and simple from basically December of 2018 until we finally cross back above them and then slope back to the upside, the 200 exponential and simple. So from 2018 till basically the end of 2020, we're in a very clear downtrend on yields for the Treasury. So this is the TNX, okay? And then this is going to obviously be directly correlated to the Fed funds rate. So obviously we reach basically like 0.5% down here. We're essentially at 0 on the Fed funds rate. The only difference being that this will never actually go to 0. It's just going to be the fixed rate of yields for the Treasury in comparison to the price. So this will be inverse to the actual Treasury bond that you would purchase. So as the price of the bond goes up, the fixed yield will go down because the price is going higher. So it's basically just that ratio between the two. And obviously, inversely, if the price of the bonds goes down, the yield will go up. So this chart right here, as it gets bullish, we're going to see actual treasuries be bearish and vice versa. So we obviously had a very strong bearish trend here, and now we're in a bullish trend. And then this is after the trend changes, after we flip above the 200 exponential and 200 simple, and they start trending to the upside, which they're obviously color coded, which is what the indicator is all about. Once it flips over blue, and then like the little more faded blue, that's telling us that we are now in a bullish trend. What do we expect to happen when the market changes? We expect that trend to flip, and then we always expect a retest, a check, the market double checking. Okay, hang on. Is this for real? If it is for real, what's going to happen? The price is going to come down to the 200 exponential and simple. It's going to get bought up, and it's going to continue in the direction of that flip. And it happens in both directions. We break under right here, try to come back up, and we consistently get rejected. And then here we come back, try to test it, try to end the trend, try to flip it back over, get rejected, continue to the downside. And once we get rejected right here, we see a very violent sell-off, like, basically a capitulation move. So this is that test right here. This is the check. This is the flip. This is the market trying to figure out, okay, people often get caught up in this whole bull-bear thing. The bulls versus the bears. It's a fight. It's a battle. It's a war. The good guys and the bad guys. The bullish traders or investors and the bearish ones. But the truth is, the market is just composed of a bunch of people that are trying to do the same thing. Okay? There's big financial institutions. There's, mom and pop investors that are just putting their money away. There's, retail traders, speculators, all this different stuff. But most people, they're not a bull or a bear. They're literally just trying to make money. That's what we're all here for. We're all here to make money. So to try to say that there's like this one army that's always bullish and another army that's always bearish is a misconception. The truth is, it's all about figuring out what the majority of the money is going to do. And the reason institutions are so important is because institutions control a larger portion of the capital that determines the direction of the market. So our goal is not to try to figure out who's bullish, who's bearish, and why. We are literally just trying to follow the trend. So we want to figure out what the market makers are doing, and then we want to do the same thing so that we can benefit from them. And then we want to try to get on the right side of the trade before the masses pile in on that side of the trade too. So that's what this is all about. This retest, when we come back down to the 200 exponential and simple, that's the market double checking like, okay, is from now on, when this price pulls back, are there going to be more buyers than sellers? Is this going to get bought up at a higher and higher low each time because people are bullish? So the retrace doesn't come back as far, and then we come and put in a new high, and then we just keep moving, and that's the trend. So here what happened was we had a nice little retrace after a strong move to the upside from our low to our high right here. And then we came back down and tried to put in a higher low. And now the market is determining, are we going to continue this trend to the upside? So this was a very clear point of interest right here as we basically came back, retested the 200 exponential and simple, chopped around in this area. And then like we've been discussing for some time now, we put in a bullish pattern. The bullish pattern being this triangle. This is an ascending triangle. So we have the same high and then we have higher lows consistently over time. So what essentially happened was we came down here to a key Fibonacci level. We pushed up to the top, found resistance, came back down at the 0.5 of that entire move. So if we look from yellow, the top back here in 2018, and we look at the bottom right here, we have our Fibonacci in place right here. And so we see that the initial move up took us just above the 618. And then when we pulled back perfectly to the 0.5. We bounced perfectly off of the 0.5, and now we're coming back up. And now look where we are once again. We're back at the 618. So we bounced perfectly off the 0.5, and now we're seeing resistance at the 618. So that is telling us this market is trading extremely technically, which is good because it means that it's more reliable. Our technical analysis is going to be exponentially more reliable when our levels of interest are getting highly respected by the markets. So as soon as we got basically this little fake breakout out of the bottom right here, it starts looking bearish. And then we reclaim those levels, come back up and retest the top of our triangle. And then when we break out of the triangle, we now expect our measure move of the triangle, which in this case, we're taking, you know, rather conservative measure move from the bottom of the triangle, our point of interest, to the top, the ascending or a flat line resistance at the top right here. And then that's going to give us our measure move breakout. So now that we've broken out to the top and confirmed that breakout with a open and close outside of the range that we're inside of, we're now looking for like 1.6 for our next target on this. And then also, when we zoom out and look at the big picture, I'm going to turn off the moving averages just so the drawing tools are a little more clear right here. We can see that consistently this has been trading very technically based on what we're looking at. We have a very clear channel that we're interacting with. We have a breakdown channel we're interacting with. We have basically a cup and handle pattern, you know, a big rounding bottom right here. And then we have a retrace, which is a smaller version of a rounding bottom. And what you want to see with a technical cup and handle like this is the cup will be a big rounding bottom right here, come back up to a point of interest or resistance. And then after that, we come down, we put in a retrace inside of a descending channel. And then after we get the break of the descending channel, we complete the measured move of the channel itself, and then also the rounding portion of the handle. So now we have our big cup, we have our little handle, and now we would expect to come back up to the resistance. So in this case, we have a descending resistance, which is basically right here to our point of interest right here where the cup finishes and the handle begins. And so we would expect now for the cup and handle pattern to eventually come back up to 1.66. And then once we get up to there, again, we would expect to run into resistance here, eventually chop through that resistance, and then we would expect for the measure move of the cup and handle to take place. So because we're in log scale, you know, I left out this giant wick right here. And I'm just doing like more of a conservative move from like our key little area of resistance down here, or support I should say, to the resistance, which is the top of the cup. And that's giving us our measure move. So when we move that up, because it's based on percentages, it gets smaller. So it looks deceptively, you know, like it's changing size. But in all actuality, it's just a percentage of the move rather than just like the, you know, numerical value of it. So when we move that back up here to the neckline, once we get the break of the top of the handle, we would expect our yields to push all the way up here. And where's that going to take us to? Well, the conservative measure move that we're using in this case is going to take us up to 3%, you know, which is, you know, obviously very high considering that not that long ago we were at 0.4%, you know, less than 0.5%. So then where does that take us to? Takes us potentially all the way back up to our macro version of, you know, this gigantic pattern that we're looking at here, you know, which was essentially this whole entire range, the blue being our support back here, the red being our resistance right here. And then it takes us up to a technical breakout of what's either a cup and handle, or arguably this could be a shoulder, the head, and then our right shoulder. And then we get the break of the neckline, which again would give us our measure move back up to the top resistance. And then if we switch out right here and we just go to the monthly, we can really see what we're paying attention to. Why this is so important. Because what it is, we have a very clear resistance here in red. And the entire time we have the support down here in blue, and it's just slowly broadening as time goes by. You know, the top less than the bottom. But we've been just oscillating inside of this range, you know, for what amounts to since 1981. So at this point in time, you know, we have 30 something years inside of a pretty reliable pattern. So the likelihood is, if we've been operating inside this area of resistance and support in a downward channel for the last 30 years, we would expect any moves that take place to continue taking place inside of this channel, which is exactly what's been happening, obviously. So we would expect it to continue happening until the one time it doesn't, at which point in time we'll break and potentially get continuation in one direction or the other. Which, because we've been in a descending pattern this entire time, a descending channel, you know, or something like a channel, we would expect eventually the breakout to be to the upside and then put in a lower high. So if we have our high back here at like, you know, 16% interest rates, we would expect eventually a breakout to the upside to take us up to a key Fibonacci level, but a lower high, and then continue back to the downside once again. And that's only just the bias of the pattern itself. Does not have to be the case, but is most likely going to be the case. So eventually what this chart is telling us is eventually we will probably get a breakout of this channel to the upside, at which point in time it would be a bullish breakout, but it would just put in a lower high. So, where's that going to take us to? Well, something like 5.5%. Well, that's not possible. We wouldn't be able to service our debts, blah, 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 blah. Sure, I totally get it. I completely agree with you. But the fact of the matter is, that's what the technicals are telling us. We're going to continue operating inside this channel, and eventually when we break out, it's probably going to be to the upside. But more likely than not, we will come up here to the top of the range and then get rejected. So that's what we're paying attention to. That's the most important thing to pay attention to. And then also inside of that, we have our Fibonacci from the top here and our Fibonacci to the bottom right here. And then we have some key fib levels that we're paying attention to as well. So here we have obviously a key support level that flipped resistance once we broke down from it. That was our 618 of the macro fib. At which point in time we started putting in, going lower and lower. So then we see some clear interactions at the 0.5 here, where it acts as resistance and support along the way, fails to break back up to the 618. So we're consistently putting in lower highs and lower lows. Come down here, obviously we have quite a bit of interaction at the 382, come back up, and now we're trying to break through the 382, which if we zoom back in here, we'll notice that the 382 is corresponding to our neckline, or the area of resistance or interest of where the cup finishes and the handle begins. So that's going to be a very difficult area to get through, that 1.6 level. But once we do get through that, it's a confirmed break of the cup and handle, and then also of the head and shoulders pattern, which would then give us over time the measured move up to the top of the range, which again is going to correspond perfectly with this. And then it would essentially be, maybe we stop at the 886 right here, which is also the 0.5, and we don't get back up to the top of the channel, somewhere around there. But this is our level of interest. This is our area of interest where we then become bearish on, treasury bond yields, which would then make us bullish, obviously, on the actual bonds themselves. So what is the macro event that takes place, that happens? What is going to be going on with the economy, with the world? Is there going to be wars? Is there going to be, this, that, and the other, collapses of government? Who knows and who cares? None of that matters. What matters is this chart has been trading extremely technically for 30 years, so the likelihood of that continuing is extremely high. And that's what we're paying attention to. And now the reason this chart, of all the charts that we look at, is so important is this is the price of money. Treasury yields, or the Fed funds rate, or whatever interest rates, are the price of money. What do I mean by that? How much money costs? Well, that doesn't make sense. What do you mean how much money costs? To borrow money. If you, have an account with the Federal Reserve and the Fed fund rate is set at, 1%, you're paying a long-term fixed interest rate of 1% to the Federal Reserve to borrow that money. Well, normal people can't get an account through them. Obviously, that's like, banks and whatever. When you go to an actual bank, though, that rate is going to correspond with the Fed funds rate. Not perfectly, but it's going to be roughly in line with it. So if the Fed funds rate is at 1%, maybe you go to the bank right now, and it's actually less than 1%. It's basically at 0 right now. But if you go to the actual bank right now and you try to take out a 30-year fixed mortgage on a house or something, and you have good credit, so you get, the best rate that they offer or whatever, you might get 2% or something like that. So what is that? Well, it's the arbitrage. The bank itself is getting the money from the Federal Reserve at 1%, and then you're getting the money from the bank at 2%. So basically, they make the 1%, they make the spread, they make the arbitrage between the difference, and then you get it at that rate, and then that's the cost of your money, the money that you're getting from them. So then as long as you can take that money and do something better, you can make more than the 2% that you're paying for that money over time, you can do well. So this right here influences not only the price of the bonds, not only the price of the actual money itself, but it's going to influence directly the price of assets in relation. Because as the interest rate that you pay for money goes down, or the Fed funds rate goes down, asset prices are going to go up. And vice versa, inversely correlated, if the price or cost of money goes up, we would expect asset prices to come back down as money costs more. So you have to be able to utilize that money in a better way. So that's why this chart is so important. This is literally the one chart that tells you, basically the direction of all assets. Now there's going to be obviously some other factors inside of each different asset class, whether it's stocks, whether it's cryptocurrencies, whether it's stocks in the United States or emerging markets, whether it's Bitcoin or some shitcoin, whether it's gold or silver, etc., etc., etc. But this chart right here is the most important chart, and that's why we always look at it first, because this gives us the broad picture of what's really going on in the economy, in the world, everywhere basically. And that's why it's so important. So, sometimes I think we like brush over this chart and don't pay enough attention to why it's so important. But what is this chart telling us on the monthly right now? It's telling us that let's turn off our drawing tools and let's look at our momentum, our indicator oscillators, and see what's going on. So obviously this entire time we've been in a bear market. We know that. Prior to this breakdown here below the 200 exponential and simple moving average in 1986, we were in a massive bull market. So we were above the 200 exponential and simple. Then we see the 200 simple moving average on top of the 200 exponential. We try to break back above it. We get rejected. And then we go into a prolonged bear market. So technically, the way I determine trend on the monthly right here, once the price action is below the 200 exponential and simple moving average, eventually we would expect the slope to roll over. Here it begins to, we see a little brief push back up where it turns back blue again. And then here we go into a prolonged bear market. So technically, somewhere around, this area, whether it was, 1987 when you come back up and get rejected right here, or whether it was once we, confirm, obviously, by the slope of the moving average flipping over in 1991. This is a 4-year period, basically, of indecision on this long-term monthly chart, after which, from 1991 until, present, 2021, we have a 30-year period where the trend is bearish. So by determining trend, we know that we don't want to be bullish on the treasury yield if we're in a 30-year downtrend on the macro. We're trading against the trend. So now what we're paying attention to, obviously on shorter time frames, is going to tell us what's happening quicker. But here on the monthly chart, we can tell something different is starting to happen. Something that, we previously came back up here and retested a couple times along the way, trying to break back up. But the final retest right here was in November of 2018, and then we got rejected, and then we basically capitulated. Well, did anybody know about COVID back here in November of 2018? Did anybody know about any of these quote-unquote macro factors that are affecting the economy and all the things that are going on? Did anybody know about them? No. That's all made up. It's all just what they tell you the reason is from all this. But this chart told us back in November of 2018 that interest rates were going to be going, extremely low. And that's probably going to be correlating with something wrong inside of the economy, obviously, if we're going down to basically zero. So now what we're paying attention to is on the shorter time frame, we have the 8 and 21 crossing back up. So within that long macro bear trend, we have from November 2016 until basically when we cross back to the downside, April of 2019, we have a 3-year period where rates rise. Here again, we see the prior one before that was June of 2013 till October of 2014. So a little over a year. We have a little bounce right here. We have a couple little bounces along the way. So that's what our shorter term moving averages are for. So here, once we bottomed out, basically, we see now the moving averages obviously we had a very powerful trend to the upside, and then we crossed them to the upside, and then we came back to retest. This is a market checking like, hey, are we sure? Are we really going to go into a prolonged uptrend on yields, for the next 1 to 3 to 5, or potentially even reverse the trend, although it's way too early to tell that? Well, this is us coming down to retest it. And now here we've pushed back up, and we have 3 days and 19 hours, so basically 4 days. Well, as long as we're above this point, as long as we're above 1.35 on the yields, that's these crossing back to the upside and telling us we're probably going to do what we have done the previous times. Most of the time what happens is we get the green cross, we come back up, try to retest them. Some of the retests are weaker than others. We don't make it up. We don't make it even close here. Here we make it up and get rejected directly at it. So, in all reality, what this is telling us is if we close above 1.35 or 6 or somewhere around there in these next 4 days, then we're probably going to revert to the mean or retest the 200 exponential and simple moving average over time, over the next 1 to 3 to 5 years, something like that. So where does that put us at? Roughly, assuming these continue to move down, and the longer time it takes to get there, the lower they will be, roughly 2.5%. So this is telling us that based on every form of technical analysis we're paying attention to, the moving averages, the patterns that we're looking at playing out, the actual momentum oscillators and indicators that we're looking at down here as well, everything is telling us that more than likely what's going to happen is with a high probability of success. So it's not just flipping a coin at this point in time. We have a bunch of things telling us more than 50% probability, in my opinion, based on how I do technical analysis, that although we're trading against the trend is down here, that on the shorter time frames, we're going to at least come back up and put in a lower high retest. So the lower high would be obviously just anywhere less than 3.16%. So is it realistic to think we could come up to 2.4 or 2.5% on the 10-year treasury? I think there's a very high probability of that. So that tells me that bonds, for one reason or another, are going to be getting wrecked. So then when we start putting in like fundamentals and paying attention to them as well, we say, okay, well, that makes sense. If the taper is going to take place, if the Fed is going to potentially start buying less bonds or selling more bonds into the market, or potentially raising the Fed funds rate, all three of those things would be bearish for bonds and bullish for the rate. Because the rate itself doesn't change, but as the price of the bonds goes down, the rate goes up in relation to what you would pay for those bonds on the open market. So we now have all the fundamentals and all the technicals telling us that even though we're probably going to put in a lower high right here, we are more than likely going to be moving back to the upside over the next few years. So then when the Fed comes out and tells us something like, hey, we're going to start to taper soon, so we're going to start buying less bonds, and then eventually we're going to start selling or decreasing the size of the balance sheet. So again, that's selling. They're going to buy less bonds, and then they're going to start selling bonds on top of that. So that's a double negative towards the price of bonds. And then eventually, 3 years from now, 2 years from now, whatever they say versus what actually happens, who knows? But eventually they're going to start raising the Fed funds rate. Well, that is a third thing, because as they raise the Fed funds rate, we would expect to see the bonds yield to go up as well. So that's basically three negative pressures on the price of bonds. And now all the fundamentals line up perfectly with the technicals. So without actually even having to hear Jerome Powell get on and puke up his bullshit, we can tell what's going to happen already based on the technicals of the chart, based on the patterns, the momentum indicators, oscillators, the overall trend, probability of success, etc. So now when we start looking at things like our momentum indicators and oscillators, the jewel thief obviously uses the stochastics and then the knife to tell us, what's going on inside this. And then obviously we have the TJD, TDMACD, which is again telling us like the momentum. MACD obviously stands for moving average convergence and divergence. So it tells us, are the moving averages moving closer to each other or diverging away from each other? Telling us, are we gaining momentum? Are we losing momentum? And is the speed of that gain or that loss increasing or decreasing? And then we use the slope line to determine the overall trend of the move that's taking place within that momentum. So now when we look at this on the monthly and we start to look at these previous times when we saw the same signature take place, well, what happened? We have basically the bearish control zone, hard buy signal, prolonged move takes place. We have once again down here, we come back down, see a brief little touch into the bearish control zone right here, hard buy signal, and then we see a prolonged move take place for the next 3 years. And now here we have a very, very powerful, quite possibly, this is probably the second most powerful move we saw. This was the biggest one, the longest amount of time spent inside the bearish control zone, and then that results in basically the move back up to retest the 200 exponential and simple, which eventually fails. And then we see here was a pretty powerful one as well. This one doesn't quite get up to that level. And then here we see a pretty powerful one again, does not get up to that level. And then here we see a very brief one here, but this one moves up powerfully. So we can't tell 100% based on the amount of time it spends inside the bearish control zone, but we know that once we go into bearish control zone and then we see that hard buy signal flash, that we're going to get a powerful move. And that's why I was so fucking bullish on yields when everybody else was, no, it's going to zero, we're going negative, blah, blah, blah. Well, okay, that's fine. You can say whatever you want. But I know that based on this signature, there is a very high likelihood of success, with the exception of something like this, where we had basically a failed or a false signal. We had a couple of these along the way where it tried to push back up and then failed and rolls over. Well, look what happened here after that point in time. And I've been saying the same thing for months and months and months. And now here we are. We have gotten a massive move, basically in the yields, in the treasury bond yields. And now, is that move done yet? Well, no, we're just running into resistance where we would expect to run into it up here prior to entering into the bullish control zone. Typically, when we come up to this area, here we find resistance, we come back down, we refuel the jet, and then we take off and enter the bullish control zone. Here we see the same thing. We come up, we're bust into it at first, and then we run into resistance and pull back down. Here we sort of front run it a little bit, don't quite get there, but always at around that level, we're going to start to see some kind of negative impact because we've just gone too fast. Too far, too fast, and then we start seeing a little weakness. So here now, again, we see the same signature taking place in correspondence with the moving averages and then also this couple of indicators, which is why I use these three things in conjunction so often. Here we see the bearish control zone, the hard buy, the cross between the 8 and 21. We see the multiple green histograms. We cross above the slope line turns blue, and then we get a powerful move corresponding with it. And then we come down here between these 2 points right here. We see this point right here and this point right here. We see this point right here and this point right here. And we put in bullish divergence. And then we get an extremely powerful move, 821 cross to the upside. And then we come up, get rejected at the 200 exponential and simple. So that's what I'd like to pay attention to, is how these things interact with each other and what they're telling me about the broader market. And that's why this chart is the most important chart to look at, no matter what assets you like, what you don't like, what you think is going to happen, the fundamentals, the technicals, whatever. This is the chart to be looking at. And more people are starting to pay attention to this, which is good. You know, whether they're copying off me, whether they're copying off someone else, who cares? The fact of the matter is people are actually looking at things that matter and not just making up some bullshit excuse for why they think something's going to happen. Now, the problem is most people will look at this chart and they'll look at it on like a daily or whatever, and they'll talk about a level that's important, but they don't understand the whole macro and why this is so important. They never switch to a weekly or a monthly or a quarterly chart, you know, because they're basically just copying what they saw someone else do or posted on Twitter or whatever. But when you really break it down and you really look at what's going on here, the predominant trend is down, but inside of that predominant trend, we would expect a retest of the 200 exponential and simple. So now here we have multiple green histograms. We've crossed over the red slope line. We're at the zero line, about to break to the upside. So eventually this slope is going to roll over and it's going to turn blue again. And every time it's turned blue in the past, we've seen multiple years, you know, from this cross, and when it turned blue was in February of 2013. We basically were in a bullish trend for the next 6 years after that. And then the time before that, here when it crossed to the upside was 2004. And then here it crossed back to the downside was 2007. So that was like a 3-year period. And then here again, you know, just getting a rough idea, 94 till roughly 98. So another 4 years. Here roughly from 87 till 91, another 4 years. So based on what's going on here, we can probably expect like a 4 to 6 year trend on treasury yields. So we're saying that treasury prices are going to go to the downside for probably the next 4 years to 6 years to 10 years to whatever, possibly even a trend reversal and the inevitable breakout of this downtrend, which is why we were looking at essentially the resistance and support levels. So if we move all the way from the bottom here and come up to the top, we're probably not going to just break out of the top. We're probably going to come back down, regain some steam, and then maybe we break out of the top. And then once we break out of the top, we hit our target to the upside, something like 5.5%, whatever. The whole world will have changed. Obviously, you know, asset prices will have reset to like normal levels. Maybe the Federal Reserve gets wiped out and, you know, they all get, you know, a tight little rope tied around their neck and a quick little drop as the people take back like the, you know, free market. Who knows? Who knows what's going to happen? But the fact of the matter is eventually we'll burst to the upside and then probably just resume the trend to the downside. But more than likely what's going to happen is we're going to just continue to oscillate inside this range. So now that we understand that, now that we understand the probability and what's probably going to or most likely going to happen on the longer term of this chart and how many things in the short and medium term are telling us what's probably going to happen here, we can have a much more accurate idea as to what we're expecting through these markets. And you can understand why essentially I probably always seem like a perma bear on so many different assets, even the ones I love. I love cryptocurrency. My channel is named Crypto Trend Trader. I made this channel because I love crypto and I think crypto is the future. But keep in mind also, I made this channel when we were in a bear market, when prices were extremely low and the probability of crypto going into a parabolic bull run was extremely high based on technicals and fundamentals. I love gold and silver. I have more gold and silver than probably most people do. I love gold and silver. I am fundamentally extremely bullish on gold and silver. I am invested in the stock market. I love stocks. I think that overall stock market is statistically one of the best places to invest your money. But based on all those things, when I put all that aside and I look at what's actually taking place and what's likely to continue taking place, this tells me as the price of money gets more and more expensive, we will see delevering in the system. We will see basically asset prices crashing, or at least resetting. Even if it's not a crash, it could be a time reset. It could be some sort of capitulation event is most likely going to take place, based on the cost, the price of money. Because the more expensive money is, the more intelligent people have to be when they're investing it. If money is free, if you can just go to your bank and say, hey, I want $1 million, and they're like, sure, here, take it. And you're like, you don't want to know what I'm doing with it? And they're like, no, of course not. 1% interest. Go ahead, take it. Do whatever you want. Just, pay us back, please. And you're like, yeah, sure, okay. You're going to do all kinds of dumb stuff with it because it's easy to make 1%. It's easy to make 1% on money, especially when you have a fixed rate over a long period of time. But if it's 2% or 3% or 5% or 20%, you're going to make sure that you damn well do something smart with that money, or you're going to be net negative. If you take out a loan on your credit card for 20% interest and you go out and just party with it and buy beers and, whatever you want to have fun with, you go spend it on a limo and a night out on the town or whatever, and then you don't have any way to pay that back, that gets more and more expensive over time. As where if you take that same 20% or whatever and you invest in a legitimate company or expanding your company or something like that that's growing at 100% a year, well, sure, I'll borrow at 20% to make 100%. I'll be able to pay it back in no time, and then my business will be better for it, and I'll reap the rewards for it beneficially in the future. But that's not what's happening right now. What's happening is people are borrowing because money's basically free, and then they're spending it on dumb shit. And that's why this is so important for the broader picture of what's going to take place. So we really don't even need to look at the TLT chart, because essentially this is just a 20-year treasury and it's just inverse to what we're seeing in that chart. So what is this chart doing? What is a 20-year treasury? Well, the 20-year bond have been in like a massive, or the 20-year time frame on the treasury bond has been in a massive uptrend since, realistically going back to the 80s. This chart just only goes back to 2000. But we can see it's obviously like the inverse of the yields themselves. So, what do we expect to happen on this chart? Well, we expect it to basically break down and have a reversion to the mean, the 200 exponential and simple moving average, which eventually will take down probably back to a key support area, which was some of these previous like bottoms right here. And, essentially like this top corresponds with some of these other key resistances and support. And depending how long it takes to get there, probably somewhere around $120 is what we would expect these bond prices to be, when we come down here and bottom. And then at that point in time, we would expect the 200 exponential and simple to act as support and then get a bounce back up to another lower high. So, that's giving us essentially the yields, and the treasuries themselves are giving us a broad view of what we can expect from the actual market itself. Let me jump back in the comments over here, and then we can get into some technical analysis on some of these assets. But I wanted to take a little time and specifically talk about TNX and TLT and why they're so important and why I spend so much time and I always look at them first. But I do want to remind you, I'm going to excerpt this video and put it in one of the statics that I released during the week. But I do want to remind you, this is not financial advice. I'm not your financial advisor. Please do your own research, trade responsibly. These markets are obviously extremely volatile. And again, I'm just trying to help people understand the broader picture. This is not financial advice. I'm not giving any tax advice or investment advice or anything like that. But by having a better understanding, you can at least make your own decisions, more educated, so that they turn from guesses into, probabilities of success or likelihood of success, etc. So let's see. That's really insightful, says Adam Yu. Thanks, man. Glad to hear. What a racket banking is. Yeah, you're telling me, man. You've convinced me to add TNX to my watch list. Yeah, it's extremely important in my opinion. The most important. If there's one thing that matters, it's how much money costs. The price of money or the cost of money. So that's why it's so important to pay attention to. He says, what I don't understand is how the Fed can taper and raise rates without crashing the underlying economy because of the increased economic burden on society. Well, what makes you think that has to happen? Like, is that just your personal bias? What I don't understand is how the Fed can taper and raise rates without crashing the underlying economy. Well, that's exactly what happened the last time, right? The Fed has been unable to decrease the size of their balance sheet. They started to decrease it and eventually had to stop. They were tapering, they were decreasing the size of their balance sheet, and then they started raising rates. You remember when that happened? That was Jay Powell. He started raising rates and he said, we're just going to automate this thing and it's going to raise rates, 25 basis points every so often. And what was that? Well, that was the crash. That was leading up to the crash. That was literally what was taking place. And then as soon as the market started crashing, they tried to do everything they could. They said, we're going to do this, we're going to do that. And nothing was working. And then finally, the Fed fixed the funds rate at 0. And then Trump came in with his, like $3 trillion, injection into the market. And they basically were able to, using the double-barreled approach, to basically like stop the markets from crashing. But that's literally part of how I knew the markets were going to crash and why it was so important to make the channel when I did. As I was basically trying to warn people, like, look, this is about to be it. And then when you look back at it now and you say, oh, well, it was all COVID. And you're like, well, COVID didn't show up until arguably the end of like November, December in China or whatever. And then realistically, like March is when everybody got scared, like in most places around the world. We started hearing about it a little bit here and there along the way. But we see signs in the charts that there was problems way before that happened. We can look at the, transportation sector. We can look at semiconductors. We can look at interest rates. We can look at, the 10-year yields, etc. And all those things were flashing massive like warning signals way before any of that happened. So was COVID actually the cause of any of this, or was it just a scapegoat? In my opinion, it was just a scapegoat. We just use that as an excuse to basically bail out an already failing, system. So in my opinion, I don't think that has to happen. I don't think that was basically when money got too expensive and it started to crash the markets. Exactly. What's that old saying? Never let a good crisis go to waste. Because now when we look back at it, like in hindsight, it's like, yeah, COVID was bad. A lot of people died. Can we even trust the numbers? Are we even sure about it? Is it as bad as what we thought it was going to be? Is it even like bad at all? Was it worth crashing like the entire world economy over? Was it worth everything? Like now with all the information and all the numbers and everything looking back in hindsight, you're like, well, no, it really wasn't. Like they, what did they say when COVID first came out? Oh, 3% casualty, 5% casualties. Like, millions are going to die, this, that, and the other. And now it's like, well, we don't even know if most of the people that died would, they had all these underlying causes, probably would have died anyway. And then, just without getting into all the extra like bullshit of it, it's like, was it really that bad? Or did we just use it as a scapegoat to get out of a situation? Did we just use it around the world to bail out the economy, to bail out the banks, to bail out the stock markets, to get control from the people? Like, because that's really what it comes down to. It's the same as like a lot of the other situations that have happened in the past. People want security, so they sacrifice freedom. And then at the end, they eventually get their security, but they lose their freedom, and then they never get their freedom back. It never comes back. We're never going to, if we go to a central bank digital currency, we're never going to have that same freedom again, because they're going to be able to monitor our transactions, see what we're buying, et cetera, et cetera. So in my opinion, this is all, it's, you could say which one caused the other, which one, this, that, and the other. It doesn't matter. It's all correlated. But the fact of the matter is we can see that the Fed raising the rates was already going to crash the market. We already saw it in the transportation sector. As money was getting more expensive, the economy around the world was basically, getting ready to crash. And then all of a sudden it was like, oh no, the crash. And it's like, oh no, it's COVID. And then they have a reason to come in and bail it out. Because they couldn't have just come in and been like, oh, we got to bail out the stock market. Rates are too expensive, this, that. I mean, they could have. They've done it so many times in the past though. But think about what happened last time when the banking system failed and they came in and bailed it out and everybody got pissed. And they were like, man, F that. So what did they do this year or this time? They just bailed out the people too. They sent everybody a stimmy check. They gave everybody money for their businesses. They gave everybody child tax credits. They did this, that, and the other. Various countries did more and more than other countries did. But in the end, it was basically just an excuse and a big bailout. It's just Adam, by the way. Adam Yu is the Japanese pronunciation. I live in Japan. Oh, awesome, man. Hell yeah. Okay. Adam, appreciate you clarifying that. It's really interesting to be able to predict major world events through financial markets. Exactly, and that's where that term comes from, or that saying comes from. Show me the chart and I'll tell you the news. You know, and that's exactly what it is. You show me the chart, I'll tell you what the chart's going to do. And then afterwards, after it happens, after we see that move take place in the chart, everybody runs out to the internet and Googles, why did crypto just crash? Oh, it's because China, you know, FUD. Oh, okay, that makes sense. Why did the stock markets just crash? Oh, COVID. Why did, you know, this, that, and the other? Everybody always goes afterwards and looks for a reason. And then, you know, it's in like the journalists or the, you know, whoever, however deep you want to get in the whole conspiracy, whoever comes up with the reason, quote unquote, why it happened. But more often than not, the chart was telling us it was going to happen way before it ever did. So that's why technical analysis, and like, in my opinion, is the most important thing. Because fundamentally, you can figure out what's going to happen in the future. Like, yeah, we're probably going to go towards green energy. We're probably going to be doing this. We're probably going to be doing that. We're probably going to have this, probably going to have that. And that can help you to get like an idea of where the trends are going to go. But in all reality, technical analysis is going to get you there like way quicker and factually and measurably. Exactly. You're looking for the narrative. Exactly. Heard of the sputtering economy model brought about by peak oil? Like to some degree. I'm not sure exactly what you're talking about, but yeah. All need models. Yeah, exactly, man. Exactly. So, and that's what we're going to talk about, oil and the dollar. So let's keep moving through here, and we will keep checking out these assets. So let's go over to the DXY next. As again, this one is correlated directly to a lot of the other technical analysis we do, but also, you know, used to pitch like a narrative, and, you know, for people to come up with what's going to happen and why. And, you know, everybody's been saying forever, the dollar's going to zero, it's crashing, the buying power. But like the actual DXY is not the dollar in comparison to asset prices. We can just look at asset prices, and that tells us, you know, are assets getting more expensive over time? Always. Everything 100 years ago was much cheaper than it is now. You know, a gumball was a nickel, and now it's a quarter, 50 cents. You know, whatever you pick, a car in the 1920s, you know, was $10,000, and now it's, you know, $100,000 or $50,000. Well, sure. So yeah, the dollar is going down for sure. But the DXY is telling us, in comparison, the dollar to other countries' currencies. So obviously this is like a basket of 6 currencies, you know, primarily the Canadian dollar, the British pound, and the euro. But this gives us an idea as to what market or what country or, you know, what economy we want to be involved in. Because if we know that there's macro trends taking place where markets are going to potentially crash, or, you know, asset prices are going to go down over time because money's going to get more expensive, which I'd say we've pretty well determined at this point in time, and clearly like defined why we think that way based on the technicals. Now this can tell us, do we want to be involved in emerging markets? Do we want to be involved in Europe and Canada and the United States and China? You know, obviously China is not directly tied into this chart, but we can go through and talk about some of that stuff as well by looking at like the dollar in comparison to like the yen or whatever. But here we have the DXY in this basket. Everybody's pitching the DXY is going to nothing. It's going to crash. It's going down. It's going down. But when we look at the chart, it's telling us something completely different. You know, again, we have a bear market that started in May of 2020, and then we retested reversion to the mean right here, got rejected, came back down, put in some bullish divergence between some of these points right here based on our indicator oscillator peaks, and then again knew that we were going to be pushing back up here, and then we have a clear resistance through this area that was acting as support. We broke down from it, came back up, could not get back above that level, also corresponding with the 200 exponential and simple. We put in a third drive of bullish divergence, you know, our traditional and hidden, depending on what time frame you're looking at. And then we knew we were going to come back up here again. So then we broke above the 200 exponential and simple. After we broke above them, we started to, instead of coming back down initially, we broke through, we came back down and retested the 200 simple right here, broke back up, and then we retested the 200 exponential, and then we retested the 200 exponential and put in a third in a series of higher lows. And then we came up here again. Each time previously we put in a high, then a higher high. That tells us more likely than not now we're in a micro uptrend inside of a macro downtrend, potentially getting ready to reverse that trend. And I say potentially because when I look at the daily right here, once the 200 exponential and simple flip back up to the upside, and we now see a positive slope on both those, that tells me we're now in an uptrend on the DXY. So it tells me that the dollar is going to strengthen in the, in this case, the daily, which is our short-term chart, if we're looking at a daily, weekly, and monthly, tells us the dollar is going to strengthen in comparison to like Canada, England, Europe in general. So that tells us, okay, if we're going to be invested in a stock market, do we want to be invested in, the FTSE? Do we want to be invested in the S&P? Do we want to be invested in, various regions or whatever, so we can get a focus as to if we're going to be places, where's the safest place to be. So if we think everything's going to go down over time, but we're still going to keep some things invested, what things do we want to stay in? Because we want to be in the stuff that's going to stay the strongest in the downtrend, because we don't want to just pull everything out and just sit on the sidelines in case we're wrong, or because, you have to pay taxes, or maybe you're locked up in an IRA or something like that, where you would have to pay a fee if you take that money out, etc. And maybe we don't even know where we're going to put it anyway, because everything's going to be going down potentially. So now here we have essentially this chart is starting to roll back over to the upside. We're retesting key levels. So now if we turn back on our drawing tool here, we actually see something very similar taking place on this chart that we're seeing on the Treasury. So what does that tell us? A potential inverted head and shoulders here, and we have broken through the neckline of the head and shoulders. So now we would expect our measure move to play out and basically to take us from the bottom of the head to, our measure move completion. Also, we have a rounding bottom right here, and then a sharp or pointy bottom. That's a Adam and Eve reversal. This is our Eve pattern. This is our Adam pattern. And then essentially like a neckline in white right here, which obviously, if we zoom back out here, if you've ever seen this chart before, this is my macro chart on the DXY. And while it is extremely busy, when you really break it down and see what we're looking at right here, this again is telling us the broad spectrum of what's really taking place. So what is taking place on this chart? And again, I just want to remind you, just because I'll probably clip this later, but this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So what is the DXY telling us right now? Well, we have two key Fibonacci's taking place on this chart. We have the first one in red that is going back here from the 1980s at the top till our bottom right here, which was in 2008. So we had a high in 1986, 85. We had a low in 2008. And then everything else inside of that has just been an internal move. So at some point in time, we're either going to break out of the top and take out the highs, or at some time we're going to break out of the bottom and take out the lows. But inside, we're just going to oscillate inside this range. We need to determine where. So if we make this red Fibonacci that we're paying attention to, extremely bright, so we can see what's taking place. Well, we had our top right here, we had our bottom right here, and then we've interacted with it clearly. The initial move back up was to the 382, and then we saw, obviously some interactions with the 236, and then after that we burst to the upside and we topped out exactly at the 618, and then we came back down and retraced exactly at the 382, exactly at the 382. We're running into, or potentially going to run into, resistance at the 0.5, which is just above our heads right now. So that tells us we're seeing, again, very clear interactions with this Fibonacci levels. And then even before we knew this was going to be the low, we were already seeing clear interactions. Here we see one at the 236. Here we see one at the 236. Here we see one at the 236. Here we see at the 0.5, a double top right there. Here we see at the 618. So based on this chart, and then obviously all the way up to the 886, based on this chart and what I'm looking at and the time frame of this, like 30 years, basically, in my opinion, we have already put in our high and we have already put in our low. So we're just going to pay attention to these key levels along the way and expect them to act as, key reversal points, or key levels that tell us once we break through one of those levels, we're likely to get continuation to the next one. So if we have a low right here and our previous high was the 886, which was back here in 2001, that tells me that probably if we continue to the upside here, we're probably going to retest the 786, which is at 114. Because we already tested the 618, and then we came back down to the 382, then we tested the 618, then we came back down to the 382. So we're eventually going to break in one direction or the other, out of this range. So when we break, I would expect us to either break down to the 236, which is 81.5, or I would expect us to break up to the 786, which is 113.9. So now we know those are our two levels of interest, our two key areas, our two key, basically like support or resistances that we would expect an interaction to happen. Either our, I have it slightly below just because of the trend line here. But either the red box up here at the 786 or the green box down here at the 236. Those are the two areas we're paying attention to. Neither one would be unrealistic because on the macro trend, we have a high, we have a lower high, and that would just be another lower high. So the trend would be continuing based on these yellow slope lines right here. And then again, we have a low here at the 236. Then we have a lower low at the 0. Then we start putting in like basically, a potentially higher low, assuming this is already our low and we're not going to break down from here, assuming this is our high and we're not going to break above this. I would expect a retest to come back down to the 236 and we would just have a low and then a lower low or a low and then a higher low rather right here. And then basically another pushback up and then another higher low, and then eventually hit the top right here, and then roll back over and continue to oscillate inside of this descending channel. So at this point in time, I'm not 100% sure that the dollar is going to go up right here. I'm not, 100% sure that the dollar is going to go down right here. But if we look at now our indicator oscillators and pay attention to them, we can get a better idea as to the actual trend and direction of that trend. But before we do that, I want to look at something else. Matter of fact, I'm going to ignore the white one for right now. Because that one is basically like a hypothetical or theoretical Fibonacci. We haven't actually put in a high up here. So let's just ignore that white one. We'll just pretend that that is not on the chart. But now here we are on the monthly, and now we're going to take a look at our moving averages and what's taking place. Well, look at our monthly right here. So what has been taking place right here is, we basically have been underneath the 200 exponential and simple moving averages with a slope to the downside, which is what I personally use to determine trend since 2003. So for the last, roughly, we crossed back above them and confirmed slope to the upside here in 2019. So for 16 years, we were in a downtrend based on our moving averages. We revert to the mean here, don't quite get there, here, don't quite get there, here, don't quite get there, and then eventually here, and we show strength, we burst through it, and then after we burst through them, what do? The same thing, we revert to the mean. We retest them to now see, is this actually like turning into a bullish trend, or is it still going to continue the bearish trend and just put in a lower high? So when we come back down and we retest the 200 simple right here and the 200 exponential, and then we push back up here, find resistance at the same level again. This was our top right here in 2017. This was our top right here in 2020. And then when we came down here in this sell-off, look at what we did. The first time we came up, we retested the 200 exponential and the 200 simple. Then we came up again, and then we came back down, and now we're just retesting the 200 exponential. So that's showing strength. So now we have a low here, we have a higher low here, we have a higher low here, we have a higher low here. Well, now we're in an uptrend inside of a macro downtrend, inside of an even larger macro downtrend. So what are we doing? Well, we're doing something like this. We're just going to come back up here and potentially put in another lower high. So what does that tell us? Well, it tells us if we're now on top of the 200 exponential and 200 simple in a uptrend, it tells us we're more than likely going to be coming up here and retesting the 786 next. So that gives us a higher probability of success taking a trade bullish on the dollar as opposed to bearish, assuming that we're going to sell back off here, because selling back off down to this level would basically invalidate our trend, because we would then be back below the 200 exponential and simple, and this would just look a failed attempt to break back up and revert the trend or flip the trend over. So then if we start looking at some of our other stuff, aside from the moving averages, we'll notice here that every time we came down inside of the bearish control zone and got the hard buy signal, we saw a corresponding decent move in that direction. So here we saw obviously the buy, sell, buy, exit the bearish control zone, and then it failed, gets pushed back down, and then we see bearish control zone in green, and then we get the green hard buy signal. We see a move to the upside. And please bear with me if you've seen these charts before, but again, I want to excerpt this and also just kind of talk about why these things are so important. Here we saw like a 9 or 10% move to the upside from the hard buy signal right here till when we topped out. Here again, hard buy signal, we see a move back up here, 22% strength in the dollar in comparison, or the DXY. And then here again, we see the hard buy signal from the bearish control zone. And then once again, depending where you're going to measure to, we see essentially like an over 33% or like close to 35% move to the upside. And then here again, we see bearish control zone, hard buy signal. From our support line right here, we get the hard buy signal right around here, and then we see another 8% move to the upside. So on average, we saw like an 8 to like 35% move based on that. And now we're flipping the trend back to the upside. So that tells us that we're probably going to see, now that we have inside the bearish control zone, exited the bearish control zone. So yeah, hard buy signal taking place. And now we're on top of the 200 exponential and simple. So for the first time, we're actually in an uptrend right now, confirmed inside of that. It gives us more of a probability that we're going to see not just like that low end 8% move, but we're probably going to see a 15 or a 20 or a 30 or something like that. Now, if we see something like a 35% move to the upside, that would be taking out this previous high right here. And that tells us that we really are in like a macro uptrend and the dollar is going to be strengthening. So then when you start looking at fundamentals and you say, oh, well, that must mean that other markets around the world, other currencies around the world are like crashing in comparison to the dollar, are getting destroyed in comparison to the dollar. Is that because there's war? Is it because there's, stagflation, a depression? Who knows? I don't know what the actual events that unfold will be, but I know that this chart is telling me that if we get anything over, like a 25% move to the upside, that we're like potentially entering into an actual hardcore bullish trend. So anything over 28% tells me something crazy is happening. But again, if we pull back out our Fibonacci tools and everything, and we say our typical range, once we see this signature show up, is somewhere around 8 to 35% or whatever. If we hit the bottom end of our target or we hit that key Fibonacci level, that's right around 23%. So the likelihood of that happening based on everything we have, that tells me there's an extremely high probability that this is in fact what's going to take place. Because every time we've seen the signature, we've seen an 8 to 35% move. Every time we've bounced these Fibonacci levels, we've went to the next highest or lowest corresponding Fibonacci level. The trend now is bullish inside of a macro bearish trend. And, basically all the things that we're looking for are telling us this is potentially bullish. And then again, if we look at the TJD, TDMACD, and we look at what happened when we flipped this blue slope line over and what happened after that. Well, we flipped it over, roughly somewhere around here. We actually still put in a slightly lower low right here, but that told us that we were starting to gain momentum to the upside. And again, if we take from, just from peak to trough, or trough to peak in this case, that was a 54% move from the bottom to the top, corresponding with the TJD, TDMACD, and my personal settings that I use on that. And again, that's the trader's dynamic moving average, convergence, and divergence. And all these indicators except for the TJD master are available for free. That one is limited to the group members only. But these two are free and a bunch of other ones too. If you're new to the channel, go down in the description and it shows you how to get them on TradingView. But again, after that, we see the next one. So this was our 54% move and corresponded to obviously a lower high, but a very powerful trend, that lasted from 1992 to 2001. So this was like basically an 8 or 9 year trend to the upside that the dollar strengthened and then resumed the downtrend to a lower low. So we put in a lower high, we put in a lower low, we continued the downtrend. So now if we assume that we're going to continue the downtrend, but from when this flipped up to blue right here on the TJD, TDMACD, again, we see at the bottom of the range, it flipped right around here. We actually put in a lower low once again. And then from that low, we then came all the way back up here and we put in basically, from a lower low to a lower high, potentially resuming the downtrend. But in this case, we did a 47% move to the upside. And then after that, we went back into a red slope line, a bearish slope line. The question is, are we going to do this pull down here to a lower low was the bearish move right here. And then we went back into a bullish trend. And now this move right here actually put in a higher low. So is that going to just, sell back off again, invalidate the moving averages, and then we're actually going to continue down and put in another lower low? Or are we seeing the potential change in trend? So we see a change in trend based on our 200 exponential and moving average. And now I'm bullish on the dollar after we start flipping them back to the upside. We see the signature that tells us we have a bottoming pattern. We see bullish divergence taking place between our key levels, our key peaks, or key troughs in this case. And now we're seeing roughly the amount of time from the top right here was July of 2001 till we reset back blue was November 2006. So roughly like a 5-year period to the downside. And then we saw basically right here where we topped out in 2017. And now here we are in 2021. So roughly 4-year move to the downside where we put in a higher low. So that tells me we're probably getting exhausted on this sell-off. and that we are potentially changing trend and going to move back to the upside. Now, does that mean that we have to take out this high right here? No, but it tells me that the likelihood of this DXY strengthening and this dollar trend strengthening and getting that 25 to 50% move is extremely likely, in my opinion. And again, that's why it's so important to be looking at the macro trend. And you'll notice that a lot of other people will say, I'm bullish on this. And I say, sure, why are you bullish? And they're like, because, and they start listing off fundamentals. Or maybe they'll give me a technical along the way with some fundamentals. But very, very rarely can someone tell you a concise, clear way that they determine whether an asset is in a bull market or a bear market. And I know for a fact that most experienced traders or investors in Wall Street or other markets use either the 200 simple, which is traditional, or 200 exponential, which is more useful in volatile markets such as crypto and whatnot, to determine trend. So a lot of people will use the cross of the 200 exponential or the 200 simple. A lot of people will use if price action is above the 200 exponential or simple. A lot of people will use the slope of the 200 exponential or simple. I like to use all those things. I like to pay attention to the orientation of the 200 exponential in comparison to the 200 simple. I like to use the orientation of price above or below those. And then I also use the slope of those two as well. So as these things start to strengthen, as the 200 exponential price goes above the 200 exponential, I start to get bullish. As the 200 exponential slope moves to the upside, I get even more bullish. As the 200 simple, price above the 200 simple, I get bullish. As the slope on the 200 simple, curves back to the upside, I get extremely bullish. So right now, based on moving averages, I'm extremely, extremely bullish. The only thing that could have me more bullish on the TJD Master right now is if we cross the 8 and 21, which are red and pink right here, back to the upside. So here we had a retrace. They crossed the downside. We found support on the 200 exponential and simple. We crossed back to the upside, saw a continuation, came back, put in a higher low right here. And now here we are getting ready to close out our monthly in 4 days above, potentially. We're at the level right now of the 21 exponential. So if we close from there, I would expect this move to strengthen almost immediately. These to cross back to the upside, and then every portion of this indicator will be bullish. And I will be, for the first time, because here's when the 200 simple crossed back over, we were already above both of them, and the 821 were crossed to the upside. So we had a powerful move right here, and then obviously it got rejected and we came back down. That was the market wanting to verify, are we in fact in a macro bullish uptrend? And this was the final test, in my opinion, was the higher low that we put in right here. And now I expect a parabolic move to the upside. And what we're seeing on all those different oscillators, indicators, and longer time frames play out. So, what happens inside of that? Well, yeah, we'll probably stay between 89 and 102 on like the shorter time frames, just because we're basically range bound between those two key Fibonacci levels. But once we get back up here and we start eating through these sell orders, I do expect the dollar to break out, or the DXY to break out. And when we do, I would expect us to come up here to either the top of the descending resistance based on the channel, or our key Fibonacci, which is like that red trend right here. So that's what I'm expecting to happen. I have some time cycle analysis stuff here as well, just to look at, but there's not a ton of data points. But again, that's why it's so, so, so important to understand what's happening on the DXY, because it is very, very important to what's taking place around the world. And, more importantly, not just because I live in the United States, not just because I'm American and like I'm egocentric, like only focused on America and what's going on. Well, no, America, the dollar, the US, world reserve currency. So its relationship to other currencies around the world is extremely, extremely important, because it is the world reserve currency. As long as it is the world reserve currency. Do I think that status goes away in the future? Sure. I don't think it's going to be the world reserve currency forever. I mean, I totally get it. I totally agree. But that's why this chart is so important. So, but I would like to remind you once again, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. That is our DXY chart. And again, an in-depth breakdown. Jump over in the comments here real quick. We all need models for how the world works. That was 01. CW says, now would a strong dollar mean lower commodity prices, or is there no correlation? Okay, so CW, there is a correlation, but it's different than this chart right here, because this is the DXY. So this is the strength of the dollar in comparison to a basket of other currencies. Those 6 currencies that I listed, primarily the heaviest weight being in the euro, the pound, and the Canadian dollar. And then it's like, I can't even remember what the other ones. It's like the Swissy and it's irrelevant because they're like 3 and 6%. It's basically just the main portion of the basket is the Canadian dollar, the euro, and the British pound. So this tells me the dollar is going to strengthen in comparison to others. And then we can look at things like, Japanese currency. If we want to look at that, we can look at emerging markets, like if we want to look at like India for potential investments over there, or Africa, or if we want to look at, China and see like, is the dollar going to strengthen? We can look at those separate charts separately. But this tells us overall the trend of where the money's going to flow. But this itself, if we looked at the actual dollar in comparison to like commodities, real estate, whatever, the dollar is in, a perpetual downtrend in comparison to those things. But inside of that downtrend, we would expect, oscillations to take place. So that's why we look at the price of money, or the cost of money, or interest rates, because that tells us the relationship between a cash position and our investments, whether it's the stock market, whether it's real estate, whether it's crypto, whether it's gold, whatever it is. So this tells us, this chart specifically is telling us that the dollar is likely to strengthen on the macro in comparison to, other world currencies, assuming that this is not just the ones inside the basket, but assuming we were just going to make a broad statement like, in comparison to all other countries' currencies, we would say the dollar is probably going to strengthen on a monthly chart for the next few years and have a very powerful move to the upside. So, this chart's going to tell us compared to other countries and where we want to put our cash and where we want to have our cash and what investments we want to have inside of various countries, and the narrative there. And then the interest rates are telling us the dollar in comparison to asset prices, because there's a direct correlation between interest rates and asset prices in comparison to the dollar. Because if dollars are cheap, if money is cheap, no matter what country you're in, if interest rates are low, you're more likely to take out loans and expand credit and have an expansionary phase in like your economy, like on the macro or micro, because you're going to take those cheap dollars and potentially invest them into like assets in the stock market, buildings to manufacture things, businesses to sell things, etc. So as interest rates are low, you would expect an expansionary phase to take place throughout economies. As interest rates raise, you would expect a contraction to take place inside of those economies, whether it's on the micro or the macro. So that's why it's so important to look at these two specific charts, because this tells us, do we want to have dollars or do we want to have assets based on the 10-year? And then this chart tells us, do we want to have American dollars or American assets, or do we want to have, English or British or European, assets or currency? So both these charts, in my opinion, based on the monthly, based on everything I'm looking at, tell me that the places I want to have my money in the future for like the next, whatever we determine the trend is, 1 year, 3 years, 5 years, whatever. But both these charts very, very powerfully on the monthly tell me that I want to have my capital in the United States based on this chart in comparison to the other basket of currencies. And then they tell me that I want to have my money in dollars as opposed to assets, because we're likely to see rates rise, which is going to have an inverse correlation on the price of assets. So if the rates rise, we would expect the stock market, real estate, we would expect, those things to fall. Now, not everything has a direct one-to-one correlation. And as we look at more and more of these macro charts, we can see different trends that take place, because we might see the dollar and the treasury yields move in the same direction. But then on a macro scale, we might see gold and silver move inverse for some periods of time, or in direct correlation for other periods of time because of other macro events taking place. So it's important that we look at not only what the specific chart is telling us, but also like the comparison between those. And that's like an in-depth version of your question. But both these two charts that we looked at, the TNX and the DXY, both tell me, one says I want to be in cash and the other says I want to be in America. So that tells me that I want to have a large cash position in American dollars, based on these two things. Now, does that mean that we're not going to see the stock market burst to the upside, or the dollar move to the downside before that plays out? No, not at all. We could easily see a micro move inside of it. But on the macro, that's what these two charts are telling me, like very clearly. So, and now I want to switch over here and get back to actually what we were talking about a little bit ago. Actually, let's look at the VIX really quick here too. And then I want to talk about oil, because oil is very important on the macro too. So this is the VIX VIX volatility index of the S&P 500. And again, let's look at the macro view on this, because people look at the daily on the VIX, but they don't pay attention to the macro. This is my VIX macro chart. Okay, and what does this tell me? Well, we have a giant bullish area right here, you know, where the bulls are clearly in control, and this thing is just going out of control. Volatility is extremely high and peaks out typically once it enters into this red level above like 45 roughly. And then again, down here, we have like the bearish control zone, you know, where we basically peak to the downside, or we see like our maximum drawdown or trough in the volatility index down here, basically at like roughly 10 and a half. And then we have a clear heart line that takes place in here, which we would expect to act as support when we're on top of it and resistance when we're down below it. So that's what I pay attention to on the macro of this chart. And then I have like a little time cycle in place right here where we saw basically a bottom in 93. We saw a bottom in volatility in 2005. We saw a bottom in volatility in like 2018. And these are just an exact amount of time away from each other, telling us where we would potentially see like our next bottom in volatility. But again, that's, you know, it's almost irrelevant because that's not until 2030 at this point in time. But just kind of looking at that, we can then break down and look at what's actually taking place. And again, the VIX is an interesting chart in that you would expect typically volatility in expansionary phases to be low and in contractionary phases to be higher. So here, when we see above the moving average, when we're above the 200 exponential and moving average, you know, that was basically what, 2007. And then what takes place during this amount of time here? Well, this is the real estate mortgage crisis. You know, 2007 and 2008, volatility goes extremely high, and then slowly, like, you know, after the crash takes place and volatility comes back out of the markets, we see like an expansionary phase take place. You know, and then again, we see, you know, smaller spikes along the way or whatever, but then our next big spike, the one that took place, was obviously COVID. That was like February, March of 2020. And again, that correlated with a crash in the stock market. So when we see peaks right here, that's peak volatility, aka typically like some sort of like craziness or crash. And then when we see, you know, our less aggressive peaks, you know, or troughs down here at the bottom, that's typically like the expansionary phase and like stability within, you know, the economy or whatever you want to call it. However you want to look at like the broad sense, because this is actually just the volatility of the S&P. So since we had that basically take place here, we saw that was above the 200 exponential and simple, and then we had some other pushes up here. And then again, once we were back above the 200 exponential and simple here, the VIX went absolutely crazy. You know, and again, we're now back down below it again, which is where we would expect, you know, this to maintain most of the time. So then if we turn off our, actually, let's leave this on. If we look right here on the shorter time frames, let's go back down to the daily now. Inside of that macro chart, since we had our peak right here, which was like the COVID crash, we then have been operating inside of this descending channel. And that's how I was able to predict exactly the bottom of, you know, the stock market on this recent pullback when everybody's saying this is the end, it's the crash, it's the blah, blah, blah. Well, I specifically said right here, if we close the week above 20, I would expect, you know, a big sell-off. Well, big compared to nothing, because that's what we've been getting lately. But I would expect it to top out right here. Until we break out of this range right here, I would expect us to just keep oscillating inside that range, which is what we've been doing basically for the last year and a half. So this is just basically telling us that more than likely what's going to happen now, we're going to probably see like little to no volatility and come back down here to the bottom, or we're going to see some more volatility and selling in the stock market as we get rejected off key levels and come back up to the top. But we don't know specifically what the direction is going to be. I can tell you my bias based on like looking at those actual charts, but more than likely what's going to happen is we're going to continue to trade inside this range. So for me, the VIX's maximum it can go to is like 27, 28 right now, and the minimum it'll go to is like 13 and a half. But overall, when we look at it, we're basically just at like the center, the heart line of both channels. You know, if this is our heart line of the channel horizontal, and this is our heart line of the channel, you know, descending, we're basically right smack in the middle, right around this range at 20. So that's our key pivot point between these two. So while we're below 20, I would expect us to just oscillate here and eventually continue to the downside. When we're above 20, I would expect us to oscillate up to the top of the range and then top there. So, but this is telling us basically when we can expect those big moves to happen based on closing above those heart lines. And that's how I was able to predict last week's move, so easily. So now here's oil, and this is the other big macro chart that is most important to me, that's often overlooked in my opinion. And this is huge because the same way that interest rates are the price of money, oil is the price of transportation. In order to move goods and move yourself and move packages or whatever around country, the world, or whatever, the price of oil is important the same way it's important to you how much gas costs to get in your car and drive to work. You're less likely to be driving around all over the place and, taking road trips if gas is through the roof at all-time highs, and same way that you're less likely to be transporting goods all around the world if it's more expensive to do so. So this is extremely important, obviously. And again, this has its own separate, important factors like OPEC. If all of a sudden OPEC says, okay, we're going to lift the amount that everybody's allowed to make and you can just produce a bunch of extra oil, I would expect oil prices to drop because you have a macro supply and demand relationship taking place. If all of a sudden more supply comes online and demand stays the same, price would go down. If all of a sudden OPEC comes out and says everybody's only allowed to make half as many barrels as they were allowed to make before, I would expect oil prices to skyrocket because if demand stays the same and all of a sudden there's less supply, the price would go up. So it's like that three-way relationship formula, supply, demand, price. So that's why this chart is so important. And then this tells us what's taking place in transports and the cost of moving goods throughout the world and our micro economies. So again, if we just start looking at those same measurements, those same metrics that we've been paying attention to, obviously this was the COVID crash, basically oil goes to zero because there's just too much sitting around everywhere and it actually costs money to store oil. So people are literally just trying to not be the one who has to pay the money to store the oil because they don't know when, transportation is going to pick back up as the entire world economy is closed off. And then obviously price starts to move back to the upside, reversion to the mean, retest the 200 exponential and simple, starts to consolidate, puts in a higher low, and then now we have moved back on top of the 200 exponential, the 200 simple, and now we're in a clear uptrend. So when oil was selling off back down here, that's how I was so clearly able to identify this area as a buy, because the first time you come back down to the 200 exponential and simple, I would expect it to be a buy. But now what we see taking place on the daily is very, very, very important. What's happening right now. There's two things that are happening right now that have me paying very close attention to what's going on with oil. One, we bounced the 200 exponential and simple right here, which is good, and they're both angled to the upside. But we now have, this is a red flag for me. The 200 simple has crossed above the 200 exponential. So that tells me because the 200 exponential is more reactionary than the 200 simple, 200 simple is less responsive to price action because there's no weighting based on closer price action. Every candle inside of that 200 period, which on the daily is going to be 200 days, is weighted equally, as where with the 200 exponential, there's a heavier weighting on the more recent candles. So that's why we see the 200 exponential is weaker than the 200 simple based on the slope here. So typically that happens at the end of a trend, whether it's the end of a trend to the downside or an end of the trend to the upside. It typically tells us that we're nearing the end of a trend. Now it is possible that we strengthen right here and the 200 exponential moves back on top and that was just a false alarm. That's fine, but it's showing us right now that what's happening is the trend is weakening. So while the trend is still clearly to the upside and I have an upside bias on this trend, I'm now seeing weakness. So that's a yellow light flashing hey, slow down on this oil. We might be seeing something happen here, basically this thing topping out. And then next, we're going to look at our peaks and see divergences taking place. So here we have an extremely high peak here. Here we have a middle peak right here. And then here we have still strengthening to the upside. So we could easily take out this level, but that becomes a point of interest now. Because here we have a peak that corresponds to, this high and this high right here. Here we have a much higher high on price action, but we have a much lower high on our indicator oscillator, telling us it took less energy to get to a higher level. So we know over time that is unsustainable. Typically, these things should move in tandem, price and our oscillators or indicators. And now here we have obviously still showing strength here on the daily, but we're at a, you know, basically the same area we were at right here. So what you want to see for this bearish divergence to be, you know, invalidated is you want to see this indicator oscillator to move above this level as price moves above that level and invalidate that bearish divergence. You know, and then it would just say we had bearish divergence between these two peaks. We sold off, found support at the 200 exponential on simple, moved back up, invalidated any potential bearish divergence between these two peaks, and we can see continuation to the upside. But it has me paying attention because there is a likelihood that we could see that divergence play out and then a more violent dump right here and potentially take out this low right here, which then tells me if this is our peak and that's our low, and then we have a higher peak here and we have a higher low than this previous peak right here, that we're in a very clear definable uptrend. So if all of a sudden this goes higher and then we take out that low, it tells us potentially the trend is shifting, and then also that would correspond with us moving below here. It would correspond with the 200 simple moving above and potentially oil entering into, you know, a longer term downtrend or something like that. But now here on the monthly, if we look at oil, I'm actually very bullish on oil, and have been, because essentially what we did was, you know, we came back up here and retested that previous peak right here before the dump. So we have a high right here, which is obviously like lower high, lower high. So we have a high, we have a low, then we have a lower high, then we have a lower low, then we have a lower high, then we have a lower low. And now here we have potentially our first higher high, you know, which we're technically higher right now, but there's still a couple days left in the month. So if this candle closes on the monthly above our previous high right here, which is roughly like where we're at now, 74.5, that will tell us that we're potentially seeing this trend shift bullish for the first time since our peak back here in 2008. So if oil has been in a, you know, clear downtrend for the last 13 years, and now all of a sudden we start to reverse that trend, you know, it's not completely reversed because we could still look at it on the macro as this is a high, that's a low, this is a higher, lower high rather, and then this is our low right here. So until we actually take out realistically 113, we can't honestly say that we're out of this downtrend, but obviously taking out this is the first step to taking out this level right here. So, and there's a huge gap between them. If we take out 75 and then we move back up here to like 100 or 110, and then that fails, well, that's still a massive move that we can capitalize on. It's like a 50% move to the upside. So even if we don't change the overall trend, we can still capitalize on like a 50% move. And depending on like what oil or stocks or whatever we're, you know, playing this on, you know, whether it's futures, like, you know, this actual chart, or whether you're investing in like oil producers or whatever, you know, however you decide to play this, you know, that tells us basically that there's a potential for a big move still to be had in this. Now, if we close this right here and get rejected, it's going to look like a double top, and then we'll probably come back down and see where we find support and have to pay attention. But obviously we have in our favor blue slope line, all green histograms, bullish control zone, and now here we are back above the 200 simple, above the 200 exponential, and we have both blue slope lines. So as long as we close this monthly in the next couple of days above 70, I will be expecting continuation on oil. And eventually, once we've broken out of this level here, we can consider the measure move either from this point to this point or from this point to this point. But essentially, you know, just on a resistance like support area, you know, we would expect this to kind of stair step up to like 85. And then, you know, next some of these other key areas like 97 or 100. And then after that, somewhere around 110. So again, this is a very important chart. And then if we look at the relationship between oil, and we talk about oil as the cost of transportation and heating and the cost of essentially doing business, because, you know, you need oil for basically anything. We need oil to manufacture things, to process commodities, to, you know, move things around the world, to move ourselves around the country. You know, oil is basically the cost of movement, the cost of heat, the cost of, like, you know, just energy in general. So if this starts to go up, if the price goes up, that will have a deflationary effect on the actual economies, like the global economy in the world. Because as the price goes up, we would expect the demand to go down because of the inverse correlation. If supply stays the same, price goes up, demand goes down. If supply gets higher, you know, and price stays the same, we would expect, well, I don't have to keep going through the same points over and over again, but, you know, it's just a correlation between like the AB equals like CD type deal or whatever. But now here we have just like a couple of Fibonacci's on this actual chart here, and we can get an idea as to what we're paying attention to. So if we have our top up here, which was the all-time high oil prices back in 2008, which obviously corresponded to the crash in the housing market, that was at like 146. And this was our COVID crash right here, which was basically at zero, where you literally had to pay people just to take your oil because you didn't want to have to worry about storing it or moving it or whatever, because everything was just stopped. Well, now here we have at the 0.5 Fibonacci level, which is basically where we're at right now, and that previous top was. If we then break out of that level, our measured move, if we take the conservative, it would be like the eve, the rounding bottom right here. If we take the atom right here, this basically looks like an eve atom bottom right there, and then taking that measured move of the breakout of the 0.5, which obviously we see a bunch of correspondence between these previous supports and resistances, that would take us back up here to potentially be retesting that 113 level. And then once we get up there, we have to pay attention to, are we going to take that level out? And is this just going to turn back into another potential like double bottom pattern? And then if we take out this area right here, we're going to come back and retest the all-time highs and potentially take out those all-time highs? Or is it just going to fail right here and then we sell off? So that's why I have this target in play. If we break through this area, that's why I'm so bullish on oil right now, is we're retesting resistance. So even like we retested it, came back down, found support right here, and now it looks like we're potentially going to chop through here. It's going to take a little time to get through all these sell orders, but then once we do, we'll start retesting these key Fibonacci's in order. First being the 382, which is roughly that $95 target, and then next being the 236, the potential measure move, and then obviously a beautiful trade setup for over 58% move to the upside, and then potentially a top. Regardless, if it keeps going, we're at least going to take profits at that 110 level roughly, or maybe even front run it just a little bit at like 107 to make sure that we lock in those gains. So, and again, this is just my macro view on this. So then what is that telling us? Well, if oil's about to get super bullish and the price of oil is about to keep going up here, blame it on whatever you want to blame it on. The fact of the matter is this is probably going to correspond with the slowing economy. So if oil gets more expensive, we would expect that, the economy is going to slow down. So this is like a macro deflationary, in my opinion, macro deflationary towards like the environment of basically the world economies. And this looks very bullish to me right now. Don't tell Kathy Wood though, she'll get mad, but let me jump back over here in the comments real quick. What'd you say, CW? If you chart US oil to DXY, you can see your 200 cross at the daily. If you chart US oil to DXY, you can see your 200 cross at the daily. Yeah, oh yeah. Well, and that's, again, that's getting super complicated too. You would, the difference being this is US oil like to the dollar. US oil to the DXY is basically saying oil in correspondence to the basket of currencies, which is the dollar in relation to those other currencies. So we don't get as clear of a picture doing it that way. But yeah, you can look at like the correlation and correspondence of how oil is going to affect like other countries' currencies as well. And sometimes you'll get a different picture. Like before gold, for instance, was making all-time highs in American dollars this year, it was already making all-time highs in a bunch of other currencies. Like if you looked at like the Australian dollar, if you looked at like, bunches of other currencies around the world, gold was already at all-time highs before it made all-time highs, in USD, American dollars. So, you can sometimes get a clearer picture when you start looking at other assets in correspondence or correlation. So, yeah, I mean, it's not bad. The more information is always better, but you just have to be careful of like dilution of the importance or validity of that information. Yeah, for sure, brother. I'm glad you're enjoying it, man. That's what it's all about. It's helping people to learn and see what's going on here. So, but yeah, let's keep going on. So that is U.S. oil. And just a reminder, again, just because I'm doing excerpts of these, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. So please do your own research and trade responsibly. So yeah, let's jump into all our assets.